What if I told you that if I'd invested in the Australian stock market instead of New Zealand's, I'd be thousands of dollars richer today? That's right, the difference between the ASX and NZX could mean tens of thousands of dollars in your future net worth. Although past performance does not guarantee future returns, in this video I will show you how a seemingly small difference in annual return can have a significant impact over the long term. And also, why everything changes once you hit that first $10,000. Stick around because the results might shock you and could change the way you start investing today. Let's start by comparing both markets. The ASX, or Australian Securities Exchange, is Australia's leading stock market. It's big, it's diverse, and has exposure to all of Australia's largest, most powerful industries including banking, mining, healthcare, and even tech. It offers investors relatively strong dividend yields when we look at other global exchanges while being highly diverse. The NZX, on the other hand, or New Zealand Stock Exchange, is much smaller. The ASX is worth $1.6 trillion, while the NZX is worth just $190 billion, over 9 times smaller. It's heavily concentrated in just a handful of companies and sectors. Think electricity generators, retirement village operators, and dairy exporters. These businesses are solid, but they don't offer the same breadth or growth opportunities you find over the ditch. Now, here's where it gets really interesting. If you look at the historical returns over the past 5 years, the post-lockdown push when many of us started investing, the ASX is up 52% versus New Zealand's 11%. To put that into perspective, every $10,000 invested in Australia would have earned $4,100 more over 5 years than the same amount invested in New Zealand. So the ASX has delivered stronger capital gains and generally higher dividends. So that's the point. Where you invest matters just as much as how much you invest. Back in 2020, I had over $30,000 invested in New Zealand's NZX 50 index. Back then, if I had chosen the ASX instead, the gap in returns would already be in the 5 figures. From New Zealand, you have a few options to invest in the NZX. First, you can invest directly into Australian stocks and ETFs using a low-cost broker like today's video sponsor, MOOMOO. This gives Kiwi investors direct access to Australia's stock market to invest in individual shares or ETFs. Vanguard, for example, offers 5 ETFs targeting Australian stocks, another for property, and 3 on the fixed income side. So this option gives you the broadest access. Locally, you have Kernel, a local index fund provider that just launched a fund called Australia 100. This tracks Australia's 100 largest listed companies. And finally, there's SmartShares, who offers 7 ETF options to Kiwi investors. Now that we've compared the two markets, let's talk about how to actually invest in them. One of the simplest, most powerful strategies is called dollar cost averaging, or DCA for short. Here's how it works. Instead of trying to pick the perfect time to buy, you simply invest the same amount every week or month. For example, maybe you can afford $200 a week, so you'd invest this every week whether the market is up, down, or sideways. What happens over time is interesting. When prices dip, your $200 buys more shares. When prices rise, your $200 buys fewer shares. It basically smooths out the ups and downs in the market and avoids making emotional decisions like panic selling when markets fall. Even professional investors looking at charts all day can't consistently pick the right timing. So this way we can save the stress and put things on autopilot and often even do better. A brokerage that I recently started using is called MOOMOO. They received the CanStar Outstanding Rewards in Australia and just entered the New Zealand market this year. MOOMOO supports the functions I mentioned before, such as recurring investments. Dollar cost averaging has never been easier, with the ability to set up recurring trades as well as reinvest dividends automatically to compound returns faster. MOOMOO is a low-cost, CHESS-sponsored broker with trades starting at $3 to invest into the Australian market and 99 US cents to invest in the US, excluding pass-through and FX costs. MOOMOO is great for both beginner and experienced investors because they offer professional-grade tools without being too intimidating. One of my favorite features is the stock screener. This powerful tool lets you find stocks based on thousands of filters including range, valuation, and technical indicators, among several other parameters. This is really useful, especially when you're researching stocks you want to invest in, as it helps you find those that match your investing preferences. If ETFs are more your thing, the comparison tool allows you to compare 3 ETFs side by side. I've used this in the past when I've been deciding between a couple options, as it makes this process so much easier to look across expense ratios, past performance, holdings, and much more. With over 26 million users worldwide and access to over 26,000 stocks and ETFs, they're a leading global broker. Their parent company is even listed on the NASDAQ exchange over in the US. And locally, MOOMOO is registered with New Zealand's Financial Service Providers Register. Between advanced charting tools, options trading, in-depth stock research, and more, MOOMOO has all your bases covered when it comes to investing. So if you want to check MOOMOO out and give them a try, use my link down below in the video description. To celebrate their launch in New Zealand, they're offering zero brokerage trading on US and Australian stocks for the first 30 days. You will also receive up to 38 free stocks, including fractional shares, when meeting eligible requirements. So make sure to check them out down below in the video description. Now, when it comes to investing, there is an important concept called compounding. It is the quiet engine behind building long-term wealth. As we make investments, we are building a larger and larger portfolio with every injection of money. This invested capital earns a return through capital gains and dividends. So when these are reinvested, we start to earn capital gains and dividends on our reinvested capital as well. Looking at this chart, the yellow bars show the money that we've put in, while the purple bars show our investment returns. In the early years, money we'd put in makes up most of our portfolio. Over time, the investment returns start to take over and ends up a much larger portion than the amount we put in. That is how anybody, even with a low income, can make an incredible amount of wealth over a lifetime. And that is why investing the first $10,000 feels a bit slow. Most of the movement at this point comes from your deposits, not investment returns. You contribute, you reinvest dividends, and the balance inches up. It can feel like nothing is happening, even though you are building the base that compounding needs. After investing $10,000, however, something changes. Investment returns and reinvested dividends start adding hundreds and thousands to your portfolio, even without investing more money. And it only gets faster and faster because a 5% return on $5,000 is $250, but the same return on $50,000 portfolio is $2,500. So the machine just gets faster and faster. Add the dollar cost averaging on top and your portfolio starts to grow exponentially. The effect of compounding is much more profound when backed by strong investment returns. Let's take a look at an example of how just a 1% difference in return would affect our portfolio over 20 years. If we invested $50,000 at a rate of 5%, we'd have $135,600 after 20 years. If we increase the return by just 1% a year, this would result in having close to $30,000 more over 20 years. So even just a small difference in return can add up drastically over time. So keep the routine simple. Automate your investing through dollar cost averaging and reinvest your dividends. One common approach people talk about when doing so is having a good payday routine to funnel as much as possible into investments. The default pattern is to simply get paid, pay bills, spend a bit, and whatever's left gets invested. The problem here is that investing is a last priority, so naturally you'd invest less. So spin the order around and pay yourself first, routing a fixed amount every payday towards investing before a single dollar is spent. Many financial experts, including Scott Pape, the Barefoot Investor, recommends thinking of this in terms of buckets. Broadly, it is recommended to have 4. One is for bills, another is for fun, another is for savings, and finally investing. Bills are essential costs like rent and food. Fun is for guilt-free treats and activities. Savings is for an emergency fund. And finally, investing is the engine that grows your wealth over time. Every time you are paid, a set percentage is automatically transferred into one of the 4 buckets. For example, if you assign $100 a week into the fun bucket, you won't accidentally spend $200. If we didn't have the structure in place, it might compromise your savings and investments that week. As required, you can tweak the ratios to fit your life, but make sure the investing portion is prioritized. To take this one step further, you can even automate your investing bucket to auto-invest into chosen stocks or funds. That turns dollar cost averaging we spoke about earlier into a routine, not a decision or a chore. To improve your payday routine around investing, you need to focus on two things: income and expenses. Maximizing income means you have more money to distribute across your buckets. On the other hand, minimizing expenses means you can reallocate funds from the expense and fund buckets into investing and savings. This will supercharge your investing and bring forward your timeline to hit $10,000 and start seeing the effects of compounding faster. If you want to level up your investing game in 2025, make sure to check out MOOMOO and get up to 38 free stocks, including fractional shares, when you meet eligibility requirements. I've included a link down below in the video description. With the market hitting all-time highs, now is a great time to start learning about investing. If you're worried about risk, now's the perfect time. MOOMOO and NASDAQ are hosting their second Global Paper Trading Championship. Using pretend money, you can invest with no risk and a chance of taking home a slice of a $200,000 prize pool. There's even a chance to get your face up on the NASDAQ screen in the heart of Times Square. The competition gives you a chance to practice investing in stocks, ETFs, and options, everything you need to get started with real money later. The competition lasts 6 weeks, so make sure you sign up to MOOMOO using my link down below in the video description for your chance to win. If you enjoyed this video, please make sure to subscribe. I post a lot of content helping Aussie and Kiwi investors navigate the market, so hit the bell so you don't miss any of my future uploads. Also make sure to check these videos out next, exploring the topic further. Thanks for watching, and I look forward to catching you on the next one. Cheers.